Good evening, everyone. I welcome you all. Namaskar, Swagatam. And I really feel happy to see you all again. And I believe you all are doing very good, studying very hard to achieve your goal to become a CA as soon as possible. So we are again in the same class, and this is our session for capital gain. In this session today, we will understand the meaning of capital gain, the introduction part of capital gain, when capital gain arises, and the provision related to this chapter. Let me tell you, capital gain, again, it's a very important chapter. It does not mean that other chapters are not important. Every chapter is very important. From the starting of basic concept, then rates of tax, then income under various heads of income. I guess you must have gone through with the provision of salary heads of income, then income from house property, then income from business and profession. And this is our fourth head of income, and that is income under the head capital gain. So good to see you all again. And I can see there are good evening wishes from Mr. Okay, Chauhan, good evening. Mohammad Farhan, good evening. Soumya is saying, good evening, sir. Happy to see you again in capital gain chapter. Same as here, Soumya. Rajveer, good evening. Priyanshi, good evening. Yes, long time. Harish, I guess Miss Harsh Kaur, good evening. Good evening, Naina. Good evening, Almas, everyone. So I welcome you all in this class. And today we will discuss the provision of capital gain topic. Before that, there would be, of course, as usual, thought for the day. And at the end of the class, or maybe after the break, there would be a small story for all of you. And I believe you must have gone through with the provisions very well, which was salary head of income and income from house property and business heads of income. Okay. So can anyone tell me the charging section under these specific heads? I have write it down already for all of you. So can anyone tell me what is the charging section of salary? You must have gone through with the provision of salary heads of income. So can you tell me what is the charging section of salary head? I also want to know what is the charging section of income under the head house property you have gone through, and the charging section of income under the head PGBP. The charging section of capital gain is section 45. I want to know what is the charging section of salary, house property, and PGBP. You can send your answer in the chat box. So who will tell me the charging section of salary, house property, and PGBP? Okay, Miss SRO. Okay, same section 15. Correct. Gayatri is saying house property section 22. Jayendra is saying 15 for salary. Farhan is also saying salary 15 and house property section 22. And what is the charging section of PGBP, students? Divya is saying correct. Salary is 15. House property is 22. What is the PGBP? Okay. Harsh Kaur is saying PGBP is section 28. Priyanshi also given the correct answer. Section 15 for salary, house property 22, and PGBP 28. Well done, students. Charging section for salary is 15, which talks about when salary is chargeable to tax, when there is a relationship of employee and employer exist, then the payment will be chargeable to tax under the head salary. House property charging section 22 having multiple condition that there should be a building, it should not be used for the purpose of business and profession. The receiver of rent would be owner or deemed owner, etc. So charging section 22 states when an income is going to be included under that income from house property. And so on, PGBP is having multiple provision to explain when an income is going to be chargeable to tax under the head PGBP. But in a summary, we can say when there is any direct or indirect income arises due to carry on business or profession or not carry on any business and profession, that income is going to be charged under the head PGBP. So these are the charging section which technically explain when an income is going to be taxed under these respective heads of income. Correct? Now we are talking about capital gain, but before that, of course, there should be a thought of the day. So the thought for the day is, for all of you, it is directly connected to you. This is actually which really connected to this profession, and it says we do not need to tell everyone about our struggle. The CA prefix says everything. You can understand how important, how impactful this is. If you're going to say someone that you are even doing CA, if there is a family function, if somebody has come to your house and if he or she is asking what you are doing, and if you're saying, I am pursuing CA, that's only very impactful. And you must have seen that there is a reaction on those people. They will say, oh, you are doing CA. So even if you are doing CA, it is impactful. People start taking your talks seriously. People start taking you seriously, that you are a sincere person. So when even you are a student and you tell someone that you are doing CA, whether you are intermediate, whether you are in a final, it is really impactful because they know how difficult to become a chartered accountant. They know what struggle, what sacrifice you need to do if you are going to be a chartered accountant. And imagine if you are completed this course, if you are a CA, then this prefix tells everyone. You do not need to tell everyone how much hard work you put in. They know that if you are a CA, so definitely you have sacrificed a lot, you have suffered a lot, and of course, now you have achieved what you exactly dreamed of. So that was the thought for the day, that we do not need to tell anyone about our struggle. Our just CA prefix says everything. So moving on to the provisions now, and this is our chapter capital gain. So for the purpose of chargeability of capital gain, the two condition is utmost important. There should be a, first of all, capital asset. The charging section 45 says that capital gain is going to be taxed if there is a capital asset and it should be transferred. So if these two conditions has been fulfilled, there is a capital asset and there is a transfer. We will understand what is the meaning of capital asset, what is the meaning of transfer. We will understand in this topic one by one. But first of all, you have to understand when section 45 applicable, or you should understand what is the chargeability of capital gain, in which circumstances, in which scenario, in which condition capital gain is going to be charged. So there must be a capital asset and there must be a transfer. So if these two conditions has been fulfilled, then capital gain provisions are applicable in the year in which transfer took place. So that is going to be discussed one by one. Okay. So we are going through with our chapter number 4, that is capital gain. Unit 4, work hard in silence, let success make the noise. Okay. So that is our charging section, section 45, and it says any profit or gain arising from transfer of a capital asset. So you can see there are two important conditions. Just like in salary head of income, there must be a payment which flow from employer to employee. So if there is any payment from employer to an employee, that is going to be considered under salary head of income. In the same way, section 45 says that if there is a transfer of a capital asset, that is going to be chargeable to tax under the head capital gain in which the transfer took the place. So in the year transfer took the place, we have to calculate tax in that year under the head capital gain. Okay. Now we have to understand one by one what is the meaning of capital asset, of course, and what is the meaning of transfer. Until we understand the meaning of capital asset or transfer, we would not be understand when it's going to be applicable. So one by one we will discuss. First of all, the meaning of capital asset. The provision says capital asset means any kind of asset, any kind of property. But there are some exception also. So the definition says section 214, explain the meaning of capital asset. A capital asset means property of any kind. Property of any kind held by an assessee, whether or not connected to your business or profession. So if it is connected to your business profession, it could be capital asset. Even if it is not connected to your business profession, it's your personal asset. Even that property could be treated as capital asset. Then point 2 said any security held by foreign institutional investor which has invested in such security in accordance with the SEBI guidelines. Any unit-linked insurance policy issued on or after 1st February 2021 to which exemption under section 1010D does not apply. So what is this ULIP concept? What is exemption under section 1010D? That is going to be discussed in detail under income from other source chapter. We will discuss this concept in detail. For the time being, you can understand only those ULIP securities, only those ULIP, those are not exempted under section 1010D will also regarded as property, that means as a capital asset. Fine. What are the details of section 1010D? On account of premium payable exceeding 2,50,000, etc. That is going to be discussed in detail under income from other source. So we can say in a very simple way, if you want to understand the definition of capital asset. So these 3 points technically saying every asset, every property is a capital asset, excluding following. This is very important. It does not include follows. So all asset, all properties are capital asset, whether any share, security, bonds, debenture, units, etc. They all are capital asset, but only these does not include. So if any of these assets fall in point number 1, 2, 3, 4, and 5, that is not a capital asset. All other assets are capital assets. So we have to understand what has been excluded. What kind of asset has been excluded? The first one is any stock in trade of business carried on by the assessor. So your stock in trade would not be treated as capital asset. So if anything which is going to be treated as your stock in trade in your business, that is excluded from the definition of capital asset. There's a reason behind it. Because if you transfer your stock in trade, the income you generate from your stock in trade would be taxable under PGBP head. So of course, capital gain cannot be applicable on that. It does not mean that stock in trade is not taxable, of course. So because stock in trade income, that would be your sale, of course. So any income on your stock in trade would be taxable under PGBP. So that's why it is not going to be taxed under capital gain. So if anything is your stock in trade, that would not be regarded as your capital asset. Clear? For example, there is a jewelry show. In the jewelry show, there are jewelry held as stock in trade. Please mute yourself. There is some voices coming. Kindly mute yourself. There's a background sounds is coming from someone. Please mute yourself, students. Okay. So moving on to the provision. So if something is your stock in trade, that cannot be treated as your capital asset. Let me tell you with the help of an example. Suppose there is a jewelry shop. So all the jewelry which is held as stock in trade, if you transfer it, that would not be treated as your capital asset because PGBP provision would be applicable. Suppose there is a Mr. A who is having jewelry and he's not dealing in jewelry business. He is in some other business or he's doing his job, etc. So jewelry for him as an asset. So if he transfers this jewelry, then capital gain provision would be applicable. But if a jeweler sells his stock in trade jewelry, then PGBP provision would be applicable. Suppose that jeweler also having some jewelry, which is as his personal asset, not as stock in trade. So if he transferred that jewelry, the capital gain provision would be applicable. Understood? I live in a house and this house is, for me, is my fixed asset. So if I transfer this house, capital gain provision would be applicable because this house is my asset. But suppose now again, there's a builder having multiple flat and houses as a stock in trade. So those houses he held as stock in trade. If we transfer that, then which provision would be applicable? PGBP. Capital gain would not be applicable. Why? Because this would not be treated as his capital asset. That is his stock in trade. Suppose that builder is also having a building in which his office is running. Understand? The builder is also having a building in which his office is running. So that office would be as his fixed asset. In the balance sheet, this office building must have been shown as his fixed asset. If we transfer this office building, then capital asset and capital gain provision would be applicable because that is not as his stock in trade. So if something is your stock in trade, that would be excluded from the definition of capital asset. Because for that purpose, PGBP provision would be applicable when there is any income from that stock in trade. Understood? So first point was exclusion, and the exclusion is for stock in trade. Moving on to the second one. Second one is very, very interesting. You will be amazed with this second number point. The second point says that personal effects, your personal effects would not be treated as your capital asset. And if I say that something is not going to be treated as your capital asset, and if it cannot be taxed into any other head, that means if you transfer that thing, there would not any income tax chargeability. So that's a good news for all of us. So it says your personal effects would not be treated as capital asset. But personal effect must fulfill two conditions. That should be movable. So first of all, it says your personal effects are not going to be treated as capital asset. So that means if you transfer it, there would not be any tax under any head of income. But the personal effect should fulfill two conditions. First of all, it should be movable and it should be used for personal use. Now, let me ask you some question, some example, and you should give answer that whether it fulfill these both condition or not. Suppose I live in my house. So does my house fulfill both of these conditions, movable and for personal use or not? You have to answer me. The house should be treated as capital asset or not? No, because house is not movable. It is used for personal purpose. The personal purpose condition has been fulfilled, but both condition must be fulfilled to treat any asset, as capital asset or out of the definition of capital asset. So my house technically does not fulfill the condition of movable. So what does it mean? The house would be a capital asset or not? Answer me. The house would be a capital asset or not? Yes, of course. Yes. Chauhan Tej Prakash saying no, it is wrong. We are discussing exclusion, that these would not be treated as capital asset. So house does not fulfill both condition. So if both condition does not fulfill, that means that would be treated as capital asset. So house is a capital asset because it is immovable. It does not fulfill first condition, movable. Now second question. I am having a car and I use that car for my personal purpose. Now, does my car fulfill both conditions? Yes or no? Remember, if the answer is yes for the both condition, that would not be treated as a capital asset. Both condition answer is yes, then that is not a capital asset. If any of one condition does not fulfill or both does not fulfill, in that situation, that would be a capital asset. Clear? So car is movable and it is for personal use. So that means it is not my capital asset. Now, what does that mean? It does mean if I sell my car, and if I earn profit, gain, then that is not chargeable to tax. not under capital gain head, not under salary head, not under house property, not under PGBP, not under income from other sources. So is it a good provision for you or not? Say it is a good provision for an SSC or not? That if you transfer your car, it would not be a capital asset. So income tax is making a beneficial provision for you or not? It is a benefit provision for you. Yes, because income tax is so lenient, so kind. They are providing the benefit that yes, you will not need to pay any tax if you transfer your personal and movable asset. Clear? Okay, furniture. In your house, there are furniture. So furniture also fulfill these two conditions, movable and personal. So if you transfer your furniture, your refrigerator, your microwave, your television, etc. Priyanshi is saying, but sir, tax will be covered anyhow. There is no tax. Let me tell you, Priyanshi, there is no tax. If asset is movable and it is personal nature, that is not going to be taxed anywhere under income tax. So if you transfer your furniture, your television, your laptop, your car, your refrigerator, your microwave, anything which is movable and for personal, there would not be any tax because income tax has excluded these movable and personal assets. So it is a good provision. You all must be thinking like that. It's a good provision. Now let's see the reality of it. We all are happy because wow, if we transfer my car, there would not be any tax. So how we calculate profit? To calculate profit, the simple formula is sale minus purchase price. So if sale price is higher than purchase price, that would be a profit. Obvious, it's so simple, basic provision. Now, what income tax was saying that if you transfer your car, suppose you purchase that car for 10 lakh rupees. And they are saying if you transfer your car and if it is movable and personal nature, we will not charge tax. We will not charge tax on your gain. Now tell me, if you purchased a car on 10 lakh rupees and if you transfer that, the price what you will receive at the time of sale would be higher or lower than 10 lakh rupees? It will always lower. Even if you purchase a 10 lakh rupees car today, and if you're going to transfer it tomorrow, you will not get 10 lakh rupees. So might be if you will transfer, suppose you'll get 7 lakh rupees. So sale price is 7 lakh and purchase price was 10 lakh. So there will always be loss. There could not be profit. Whether it's a furniture, Mr. Sangeeta Vani is asking if it is a jewelry. Do not worry, Mr. Sangeeta Vani. We have a special provision for jewelry. After this, we will discuss that exclusion also regarding jewelry, etc. First of all, we are discussing about car, furniture, etc. I will explain you how smartly government had played with this provision. Okay, so just stay with me. I will explain each and everything. Okay, so we thought that there's a very good provision because we are not going to pay tax on any of these kind of profit. But suppose whether it's a car, whether it's a furniture, whether it's your refrigerator, whether it's your TV, monitor, even mobile, laptop, etc., there would be always loss. Understand? There would not be profit. Never. And if income tax does not make that provision, if they did not exclude these assets from the definition of capital asset, the income tax knows that there would always be loss. So what you will do? There is a loss. And suppose there is a profit under any other head of income. Suppose there is a profit of any other capital gain, 5 lakh rupees. So there would always be loss. But what we will do? We will set off this loss from our gain. So the aggregate profit would be lower. So income tax would collect reduced tax due to this losses. Suppose capital gain is 15 lakh. But there is loss, suppose 10 lakh rupees. So you will remain with the 5 lakh rupees capital gain. Up to 5 lakh, we need not to pay any tax. Okay, 5 lakh, 7 lakh, etc. So income tax plays very smartly. And they make a provision that if the asset is personal and movable, that is excluded from the definition of capital asset. So there would not be any loss we have to set off. So always this loss be treated as zero because that is not your capital asset. So you understand? You think that is a provision which is for your benefit, but that is not the reality. The benefit is of income tax department. Now there comes a question that there are certain things, personal and movable, those value increased after time, like jewelry, gold, antique things like old painting, drawings, etc. So there are certain movable and personal things which will always result in gain, like jewelry. You can see the price of gold right now. It's actually crossing 1 lakh, of course. So if somebody has purchased jewelry in 2010, at that time, I believe the jewelry rate was suppose 18,000 or 20,000, suppose. Right? Now that is for 1 lakh. So if that person sale, that will always be profit. Nidhi is asking what is archaeological collection. Nidhi, I will read each point one by one. Do not worry. I'm just trying to explain you the provision first. Do not go fast. Stay with me. When I will explain this provision, I will read all those points. The archaeological collection, the sculptures, painting, drawing, etc. one by one. And I'll explain each and everything. So this is the method of studying, that when any faculty, any teacher is trying to tell you something, focus on that thing. And if you are understanding that thing, then the faculty will explain you the other thing when the time will come. So we will cross the bridge when the time will come. Till that, just stay with me, understand what we are discussing. Okay. So Dhanush is saying, sir, on car, we have to pay for the difference value, right? We do not need to pay anything because there would always be loss, Mr. Dhanush. We need not to pay anything. Okay. There will not be any tax. So in case of some movable things, those are personal nature, there will always be profit. So income tax department think that if we exclude all personal assets, those are movable. So in case of jewelry, gold, etc., there would always be profit, and that would result in loss to the income tax department. Because if you exclude jewelry, etc., also, so in that case, there will always be profit. So what department did? Department exclude those assets which will result in loss always, like car, furniture, etc. But department include those movable and personal assets which will result in profit generally, like jewelry, etc. So now we have personal asset, those are movable. There are certain, those are going to be excluded, but some has been included in the definition of capital asset. Now let's see the definition. So point number 2 heading says personal effect, movable property including clothes, furniture for personal use, those have been excluded from this definition, but excluding. So we are not including those capital assets, those are movable and personal, but excluding these assets. So these are also personal and movable, but we exclude these from the definition of not treated them as a capital asset. So what is the meaning? That these 6 assets, they are personal and movable, but we will treat them as capital asset for the purpose of capital. And you can see in all these 6 assets, there is a common nature. And that means always they will arise in the nature of gain. So these are personal assets, but it will be treated as capital asset for the purpose of capital gain. Now, what are those? Jewelry like gold, precious metal, etc. Archaeological collection like old antique things. If you found any old civilization item, that would be called your archaeological collection. Old drawings like painting of Mona Lisa or Da Vinci, etc. Any kind of like painter, or those have been made a very valuable painting, etc. Those value increased after time. Those kind of drawing and painting. Sculpture again, old statues, etc. Or any work of art. So any work of art include any other antique things. So if you your asset does fall under these 6 assets. So even if that is for personal ledger and movable, but that is included for the definition of capital asset. Generally, price will increase, and because price will increase, so that is result always in the result of gain, and that will collect the tax in that nature. Miss Mominder Sethi Bhavya is saying, in case jewelry transfer for loss, how it is possible that jewelry would be transfer for loss? The market value, we will take the market value for the purpose of your sale consideration. If your jewelry value is 10 lakh rupees, you have purchased it for 2 lakh rupees. Loss will be set off to capital gain, but there would not be any loss. Miss Mami Diseti, how there would be loss in case of jewelry? There would always be profit. Okay, next, Mr. Chauhan Tej Prakash saying, sir, for example, we bought painting and sold it on less price, so we have loss. If you intentionally sell anything at a loss or a low price, your price would not be considered. Suppose income tax is more intelligent than you. So if you are planning, you start planning how we will avoid tax. So what you are thinking, department has already made provision for that. So your sole consideration would not be considered. The sale consideration means the market value. Suppose I have bought a painting for 10 lakh rupees. It's an antique painting. And the market value is not 15 lakh rupees. But I transfer it to someone for 8 lakh rupees. So the 8 lakh would not be treated as consideration. If the market value is 15 lakh rupees, then you have to pay tax according to the market value. And all these provisions has been already incorporated under capital gain chapter. So what you are trying to do, as I told to a student, that do not try to run faster, because all provision has been made. If you'll try to think how to avoid tax, do not try to think it. Already provisions are there. So one by one, you should understand what we are trying to teach you. We are discussing the definition of what is capital asset, what is not. And you are trying to find out the loopholes in the tax avoidance. That is not possible. So all of these kind of query would be discussed. So what we are discussing, you should ask about that. That, sir, this is capital asset, this could be capital asset or not. But if you are asked that, sir, we can avoid tax like that, we can sell it at a low price, so do not do that. Already provisions are there. Okay. Mr. Gokul Kotle, if stolen, sir, we have also the provision for stolen also. If it is stolen, there's a provision under transfer definition. So if it is insured, you can claim the loss. If it is not insured, you cannot claim the loss also. So stolen provisions also there. Do not worry, every provision what you can think, and if even you cannot think, that has been made already in the syllabus. Mr. Chauhan Tej Prakash saying, no, sir, actually price go down. Okay, now you are talking correctly. Suppose it happens that jewelry price actually go down. Then if there would be a loss, that loss you can of course set off from any other of capital gain. If it is a genuine loss. Now your question is correct. Okay. Priyanshi saying department has seen more Diwalis than us, no doubt smarter than tax saver. Okay. Chalo. So moving on to the, first of all, we have discussed what is does not include under a definition of capital asset, any stock in trade. The second is personal asset, but personal asset having two kind of provision. If that movable and personal nature, that would not be included except these 6. So these 6 would be treated as capital asset. Other than that, any personal asset which is movable, that would not be considered as your capital asset. Now the third exclusion is agricultural land in rural area. So if there is any agricultural land in rural area, what we have already discussed under chapter number 2, residential status provision, we have discussed the definition of rural area, etc. So if there's agricultural land situated in rural area, in that situation also, that would not be treated as your capital asset. Now we are having 6.5% gold bonds, 7% gold bonds, national gold bonds, special bearer bond, etc. These are specified security. Those have been excluded from the definition of capital asset, and gold deposit bond issued under gold deposit scheme 1999, gold monetization scheme under 2015 and 18 notified by the government. So you can summarize these 2 points as that except these two securities, except these bonds, which has been mentioned in point number 4 and 5, all other bonds, debentures, shares, security, etc. are capital assets. So these 4 and 5, not a capital asset. Except these two, all kind of bonds, debentures, shares, security, etc. are treated as capital asset. So these 5 has been excluded from the definition of capital asset. So we have gone through what is the meaning of capital asset. Now the concept of capital gain says when there would be capital gain and when there would be capital loss. It's a very general thing. If your purchase price is less than, if purchase price is less than sale price, that means sale price is greater and purchase price is less than sale price. That would result in profit. And that profit would be treated as capital gain. What is capital loss situation? Of course, vice versa. If purchase price is more than your sale price, and that would result in capital loss. Now, there's a very interesting thing about this chapter, that this chapter is having the easiest format. Easiest format. You have already gone through with the salary head of income, with income from house property head and the PGBP. And I believe that you must have remembered the format to calculate salary head or PGBP head income or house property. So under salary head of income, we have to find the basic salary, then allowances, multiple allowances, taxable value of allowances, then multiple perquisites, then compensation, the retirement benefit like gratuity, pension, leave encashment, etc. After that, you will find the gross salary. Then we have certain deduction, also standard deduction, professional tax. Then we will find out the taxable salary. So you can imagine that how huge that format is. In the same way, there is income from house property, in which we have to first find out gross annual value, for which you have to find out the municipal value, fair rent, and then standard rent, then higher, lower, then GAV, then NAV, then you have to deduct standard deduction, then interest deduction, etc., municipal tax, etc. Then you will be able to find out the income under that house property. So, of course, a decent format with having multiple provision. And so on, PGBP format does not end anywhere. There's no specific format. You have to add multiple disallowed expenditure and you have to reduce the multiple disallowed incomes also. And after that, the specific adjustment. So that is a huge format. But the most easiest format is under income under the head capital gain. If I'll ask you, how are you going to calculate the capital gain or loss? So the sale minus purchase is the simple formula to calculate the capital gain or loss. So if sale is higher than purchase price, there would be gain or loss. So we have a specific format for this also, a very easy format. So to calculate capital gain, first of all, in the question, we have to find out the sales consideration. At what price the assessee has transferred that particular capital asset. That would be given in the question. So what we received monetary or even non-monetary, that would be sale consideration. If there is any expenses on transfer, like we have to pay any processing fees, legal fees, commission, brokerage, that needs to be reduced from the sale consideration. We call it expense on transfer, like commission, brokerage, etc. So the main thing we have to find it out firstly is net sale consideration. I call it point A or whatever it is. So we have to find out in the question net sale consideration. Suppose in the question there is no expense on transfer, then your sale consideration would be automatically your net sales consideration. Clear? After finding out net sale consideration, we have to subtract the purchase price. We call that purchase price in the technical language of this chapter is cost of acquisition. And you can understand exactly what is the meaning of this word, cost of acquisition. That means in practically we are talking about purchase price. So we have to reduce cost of acquisition. That means purchase price, and there's a new word that's called index cost of acquisition. Now, what is this index cost of acquisition? We will discuss this after the definition of transfer. So there is some concept in which we need to find out index cost of acquisition. Generally, it is our purchase price. How we need to calculate it, do not worry, we will discuss after the concept of transfer. Then, if after purchase of any asset, if you have incurred any expenditure after purchase on the maintenance of that asset, like renovation, construction, repairing, etc., that we also reduce from the sale consideration. Suppose you purchase any asset for 10 lakh rupees, so that would be my cost of acquisition. After 2 years, I have to invest 1 lakh rupees for the repair and maintenance of that asset. 1 lakh rupees. So that is called cost of improvement. So after purchase, if there any other expenditure, that would be said cost of improvement. Again, there is a concept of index cost of improvement. We will discuss what is the meaning of index later. So that means capital expenditure after purchase. So either we are going to do some revenue expenditure after purchase or capital. Under capital gain, we only consider the capital expenditure done after purchase. That we call cost of improvement. Okay. After reducing cost of acquisition and cost of improvement, we will have our capital gain or loss. This capital gain or loss has been divided into two categories, long-term or short-term. When it will be considered long-term, we will discuss that. When we will treat that short-term, we will also discuss that. So either it would be long-term capital gain or short-term capital gain, or there could be loss also. So even the loss would be treated either as long-term capital loss or short-term capital loss. So in this format, we have to understand three things. What is the meaning of index cost of acquisition? What is the meaning of index cost of improvement? And what is this long-term and short-term? So after the definition of transfer, we will understand the long-term, short-term, and then after that, indexation concept. Till now, any problem, any query, you can ask. In module पेज नंबर 3.366 का एग्जाम्पल समझा दीजिए सर निधि विश्वकर्मा. अभी हम मॉड्यूल डिस्कस कर नहीं रहे हैं. लेट मी सी पेज नंबर यू आर आस्किंग 3.66 3.366. Just wait, let me see. We will take each and every illustration, test knowledge question, example also. This is for agricultural land provision, I guess 3.366. So we have discussed the definition of agricultural land, that is rural area and urban area, in chapter number 2, when we discuss the provision of agricultural income. So you have to go through with that provision. I took that classes of agricultural income in which we have gone through the provision of rural area. There is specific limit of 10,000 population. Then we have 2 kilometers, 6 kilometer and 8 kilometer criteria. According to that, we have to find out which is urban area and which is rural area. So kindly go through that chapter, agricultural income, in our lecture of residential status. If there is any issue, even after reading that, you need to try this question. If there is any issue, I will solve this question in our next class for sure. But first of all, you have to try yourself. Very simple question it is. You might not able to solve it because you might not go through with the provisions of agricultural income, in which we have discussed the definition of rural area. Once try to solve it with the help of that lecture. Even if there is a problem, you can ask me. I'll solve it for next lecture for sure. Okay. Soumya is asking, sir, in cost of improvement, both capital and revenue expenditure will be considered? No, Soumya. Only capital nature expenditure need to be considered. as I've mentioned in the format, only capital expenditure. Suppose there is a building and you have done some renovation, repair, whitewash, etc. So that is considered as revenue expenditure. But if you have construct a new room, that would be treated as the capital expenditure. So that construction cost is going to be included, but only whitewash, simple repair, renovation, etc. that is not going to be considered. Same example also there. So please, Ms. Nidhi, try to solve it from there. Then we will solve it later if you are having any other problem in this question. Okay. So now moving on to the definition of transfer. Transfer for the purpose of capital gain includes. Why we are reading this definition of transfer? Because in the initial section 45 says there must be a capital asset and there must be a transfer. So the first point says transfer generally does not include only sale. It is a wider term. It includes sale also, barter system also. Everything has been included. So it's a very important definition for the purpose of this chapter. You have to understand in that question, if any of these 6 conditions has been fulfilled, 7 points are there. 1, 2, 3, 4, 5, 6, and there is 7 also. So any of this condition has been fulfilled. It does mean that the transfer has been taken. So if there is a capital asset and if any of these 7 conditions has been fulfilled, so capital gain provision would be applicable. The first point says if there is sale or exchange or relinquishment. Somebody was asking me if the asset has been stolen. We have also the provision in this definition. Okay. So sale, exchange, and relinquishment. If any of these 3 things has been happened with your capital asset, that would be treated as transfer. Now, what is the difference between sale, exchange, and relinquishment? We have to see that. Let me explain you with the help of an example. Now, suppose there is an asset you have purchased for 10 lakh rupees. Fine. And you have sale it for rupees 12. Sale means you have consideration in monetary term. So difference between sale and exchange is sale means you have consideration in monetary terms. So when you have monetary consideration, now we have just discussed how to calculate capital gain. There must be a sale consideration, then expense on transfer, but the basic provision is sale minus purchase price. The purchase price is called cost of acquisition, etc. But that's the basic format to calculate capital gain. So what is your sale consideration? So if you transfer your asset as sale, so whatever monetary you will receive, that would be my sale consideration in case of this transfer. Suppose I have purchased something for 10 lakh rupees and transfer it or sell it for 14 lakh rupees. So it is called a sale and 14 lakh would be my sale consideration. Clear? If it is not sale, it is exchange. Now suppose I was having a house I purchased for 10 lakh rupees and I transfer this house to Mr. B and he gives me shares worth rupees 13 lakh. So now we receive another asset in response of my asset. So now this is not sale. We will call it exchange. Exchange means barter system. I know you all know about the barter system. So if there is a barter system, then for calculating capital gain, what should be sale consideration? So the provision says what asset you are receiving, the market value or the value of that asset would be treated as your sale consideration. So if asset has been transferred via exchange, then the value of the asset you are receiving would be the sale consideration. Clear? Cost would be 10 lakh rupees. Now first was sale. What we will take? Sale consideration. In case of sale, monetary value. What we will take? Sale consideration. In case of exchange, the value of the asset we receive. Okay. Now the third was relinquishment. Now relinquishment is a very interesting and wonderful word. The basic meaning of relinquishment means to waive, to donate something, to leave our right and transfer my asset to someone else without consideration. Without consideration. So relinquishment means, if I need to tell you in a very simple way, relinquishment means waiver of ownership in favor of someone. To waive my right. In a simple language, we call it gift. So when I gift any asset to someone, that means I transfer my ownership without consideration to someone. So technically, it calls relinquishment under capital gain definition. So if I waive, that means if I transfer my asset as a gift, even donation, etc., that would be called relinquishment. Now you will tell me, what would be the sale consideration in case of relinquishment? Suppose there was a house. We are taking the example of this house, which I purchased for 10 lakh rupees. And suppose I gift this house to someone. So what would be the sale consideration in this situation? What is the sale consideration in case of gift or donation, etc.? Okay, Mr. Chauhan Tej Prakash asking, sir, painting include all type of those which are expensive, those are having higher value, those will be considered, those have been valued. If I'll make a painting, that would not be considered. But if M.F. Hussain made a painting, if Leonardo da Vinci made a painting, so that kind of painting, those will fall in antique painting definition, or those are having value in market. Those will be considered. Okay. Mr. Mohammad Farhan is saying FMV on the date of gift. No, I am not asking what should be the consideration in case of capital gain. I am asking general thing. If you gift any of your assets, suppose you have a mobile phone, you gift it to your mother. Suppose you are having your mobile phone and you gift it to your friend or mother, anyone. So what you receive in exchange? Practically nothing. Zero. There would be no consideration. That's why we called it gift or donation. If you gift something to any beggar, if you donate something to any beggar or in any temple, anywhere, so did you receive anything in response monetary? No. So there would not be any monetary consideration against gift. Clear? So what would be the monetary consideration in case of gift? That would always be nil. Always. If you are voluntarily leaving your right on any asset, if you are voluntarily leaving your ownership, so that means you are not receiving anything. So that means the consideration would always be nil. And the purchase price is 10 lakh. So there was always loss. Always. In case of relinquishment, in case of gift, donation, etc., there will be always loss. Now there's a problem. If there is loss of 10 lakh, and suppose you have capital gain on shares 15 lakh. So if you gift any asset to anyone, there will always result in loss. So that loss would be set off and your profit would be decreased. So that means tax would be decreased. So what income tax does? Income tax says, okay, gift is a transfer. Relinquishment is a transfer. You have a capital asset, building is a capital asset. So that definition has been fulfilled, and we are treating gift as a transfer also. So that means capital gain provision would be applicable. But income tax understand this thing, that in this situation, there would always be loss. And due to that loss, we will lose our revenue, our tax. So what they did not do anything over here. That transfer definition includes gift. But what they do very smartly, there is a section we will read under section 47. Section 47 says transfer not regarded as transfer. In short, exempted transfer. So under section 247, in the definition of transfer, they say yes, gift is a transfer. So because gift is a transfer and it is a capital asset, so that would be in loss. We say, okay, this loss we will set off from our profit. But in the following section, section 47, we will read later, they include this gift in the definition of exempted capital gain. So what will happen? This loss would be again 0. Now let me tell you very important thing. If in the examination question asks you whether relinquishment or gift include in the definition of transfer, the answer is yes. Gift is transfer, donation is transfer because it has been included in the definition of relinquishment. But if the question asks you whether this would be a chargeable gain or not, then you can refer as per section 47. This transfer would be exempted transfer, so that will not result in any kind of loss. You will understand this in more detail when we will read section 47. So till now it is transfer. Till now, if I'll ask you, you will calculate loss. But this loss would be 0 automatically when we'll read section 47 later. This is income tax. Interesting. Okay. Mr. Dhanush is saying, sir, but donation deducted from income under standard deduction, right? Those are different kind of donation which we give to any trust, etc. Not this donation we are talking. This is donation of asset. So in kind, if you donate anything, for that you cannot claim deduction. So deduction would be under section 80G, and that is for monetary only donations, not in kind donation. Again, that is happening. We are discussing this provision. Why you are thinking about that deduction provision? Deduction section 80C to 82U would be discussed, in which you will understand this concept. Under capital gain, the treatment is this. That is clear. If that is clear, you are on the point. So do not merge those provisions which we did not yet discuss. That will confuse you a lot. Okay. So relinquishment, one meaning under capital gain was gift and donation. The other meaning is destruction, lost, stolen, etc. So in the first case, asset was here, but we transfer this asset to someone else without consideration. In B case, relinquishment include those cases in which asset has been finished, whether it has been destroyed, lost, stolen, etc. So if your asset has been destroyed by fire or any accident or lost or somebody has stolen it, etc., then that is also transfer. Income tax, do not worry. If your asset has been stolen, lost, destroyed, we will consider it as transfer, but there would be two situations. Either it would be insured or maybe non-insured. Suppose somebody has stolen your jewelry, so maybe it was insured jewelry or maybe it is not insured jewelry. So if it is insured jewelry, then that would be regarded as transfer also, and sale consideration will be a insurance compensation. Whatever insurance compensation you will receive, that would be sale consideration. Clear? Like the house, suppose our house is destroyed by fire or an earthquake, etc. And we have taken the insurance. And insurance value, the house value was 10 lakh. So generally insurance value would be, we will receive the compensation, of course, less than the insured value. So the value is 10 lakh. Suppose we have received compensation 8 lakh. The purchase value is 10 lakh. So in that case also there would be a loss. So in majority cases, in case of destruction, lost or stolen also, there would be loss always. Or either would be equal. You will receive 10 lakh against the asset value of 10 lakh. Very rare chance of gain. Maximum chances of loss. But there's a good thing. This loss is allowed. this has not been exempted. So if there is a loss due to destruction, stolen, etc., that loss you can set off from any other income of capital gain. So if suppose there is a capital gain income of 5 lakh and there's a loss of 2 lakh due to this insured, then this loss can be set off. So this is allowed. This is not exempted later also. This is allowed loss. But suppose that is not insured, then what will happen? You will not get any insurance compensation because that is not insured. But cost would be full. So now there will be huge loss. And department says it's your mistake. We say you shouldn't take insurance. And if you did not take insurance, that this loss would not be recognized. So this loss would be zero. Only insured loss cases would be treated as relinquishment. Understand? So those were 3 points in the definition of transfer, the sale, exchange, and relinquishment. Relinquishment means waive right on asset voluntarily. That means gift, etc., an asset owned by other, and destruction of asset. So we have discussed this voluntarily provision, gift, donation, etc. And this destruction of asset is having two provisions, insured or not insured. If it is insured and if it is gain, taxable. If it is loss, the loss you can claim against other income. But if it is not insured, then that would not be considered as transfer. So that loss would be zero. The second definition of transfer is extinguishment of any right on any asset. So the meaning of relinquishment first was when you waive your right voluntarily, अपनी मर्जी से आप अपनी एसेट किसी और को देते हैं, that means gift, etc. But the extinguishment means when somebody confiscate your ownership on any asset legally. It's not, we are not talking about that it is criminal offense. We are talking about that is legally somebody takes ownership from your asset legally. That is called extinguishment. Suppose you have taken a loan to purchase a house and you have to pay EMI to the bank. But after paying some EMI, you are defaulted, you are not able to pay EMI, then what will happen? Your property would be taken from you. The ownership from that property would be taken from you by the bank. So that's called extinguishment of any right on any asset. An extinguishment would be considered as transfer. So in this situation, what would be the sale consideration? If we taken anything on loan, etc., and not able to pay EMI, that ownership would be confiscated from us. The sale consideration would always be zero, because if you are not able to pay, they will confiscate your right and the bank is not going to pay anything to you. And what would be the cost? The down payment you have done or the EMI payment, whatever you have done, that will be your cost. So that is also going to be loss always. The cost would be, suppose 5 lakh. 5 lakh down payment, EMI, whatever you have paid till now, that would be your cost. So in this situation also, there would always the loss, and this loss you can set off from profit also. So in case of extinguishment, there would always be loss, because at the time of confiscation, the bank is not going to pay anything to you. So sale consideration always zero. Whatever you have paid, down payment, EMI, etc., that would constitute your cost, and that is going to be result in loss always. But that loss is allowed. You can set off it from your other capital gain income. Miss Priyanshi is saying means abnormal loss only you can take it, any kind of loss. Normal, abnormal does not matter. Due to any reason, if there is destruction of asset, if there is stolen or lost, that loss can be considered if that is insured. So insurance compulsory for loss booking as per law. Under capital gain, we can say yes, if that is asset is not insured and that has been destroyed, then for the purpose of claiming that loss. That is mandatory from the point of view of income tax. Mr. Ishant is asking, sir, if for uninsured asset we receive compensation from any person, then what it be the sale consideration? How you will receive compensation from uninsured asset? That would be a gift from someone to you, not against that asset. So if asset is uninsured, legally whatever you will receive, that cannot be treated as compensation in that situation. So that would be a gift, and in case of that monetary gift, income from other source provision would be applicable. Miss Monji is asking, like parents passing their property to their child is also called extinguishment? No, how it is possible? Children are not confiscating their asset legally. Parents are voluntarily transferring. So that would be relinquishment, gift. So parents transferring voluntarily their property to their children. So that is technically a kind of relinquishment, okay? Not extinguishment. Fine. So that was first point. Second point. Now third point, compulsory acquisition under any law. So if the law, the government acquired your property compulsory, that is also transfer. We have a specific section of this provision, section 45(5). So we will discuss the concept of this definition as well as the provision under section 45(5) later. Conversion of capital asset into stock in trade of business of the associate. So if you are having any capital asset and you convert that capital asset into stock in trade, so that was also going to be treated as transfer, and the provision will be discussed in detail with the meaning under section 45(2). Because you will understand these two provisions only when we will take the example of these kind of provision with the practical question. So we will discuss section 45(5) and 45(2) in detail when we will discuss these provisions in detail. Okay. The maturity or redemption of a zero coupon bond. So if there is a zero coupon bond, the maturity redemption will also going to be treated as transfer. Now point number 6 and 7. So I need to ask one question to all of you. Under income from house property chapter, there is a section which is section 27. Can you tell me what is section 27? What section 27 explain? Somebody answered. Very good. Mr. Ishan is saying deemed owner. Exactly. Section 27 explain the concept of deemed owner. Very correct. In that concept of section 27 deemed owner, what we are going to discuss under point number 6 and 7, that is already included under income from house property, section 27. So the same concept, point number 6 and 7 is going to explain you again. That is from the point of view of the buyer. Under income from house property, the deemed owner concept, the point number 6 and 7 is exactly same. And that is explained from the point of view of buyer. And under capital gain, we are discussing this provision from the point of view of seller. Okay. So that's how income tax is connected. Point number 6 says transaction involving possession of immobile property in part performance. Part performance means without registry. So the provision says if any immobile property has been transferred from Mr. A to Mr. B, in which possession has been provided and the consideration has been taken. Suppose there is Mr. A and there is Mr. B. Mr. A is having a property and Mr. B wants to buy it. The consideration is suppose 2 crore rupees. So Mr. A gave possession of this property to Mr. B and Mr. B paid 2 crore rupees consideration to Mr. A. Clear? So income from house property says, in this case, Mr. B will be treated as deemed owner even when the title has not been transferred. So in case of immovable property, the title transfer is via registry. We called it registered deed. So if Mr. A transfer any property, the possession of property to Mr. B, and Mr. B provide the consideration to Mr. A, but there is no registry has been done. The title legally has not been transferred. So in this situation, generally income tax treat something in the definition of transfer when the title transfer. So until registry done, we cannot treat it as transfer. And because we cannot treat it as transfer, we cannot charge capital gain. So that was the tax avoidance thing which was in the hand of assessee. So generally, what kind of transaction has been done earlier, that someone is going to give possession of a property, the other one is transfer money, and they do not go for registry. Due to that, Mr. A, the seller, avoid capital gain tax. Due to that, buyer avoid stamp duty, because if you go for registry, you have to pay the stamp duty of 7 or 8 or 10%. So both were in the benefit. Mr. B is avoiding the stamp duty. Mr. A was avoiding the capital gain because there was no registry. That's what we call part performance, because the registry has not been done. So due to the amendment in point number 6, income tax include that kind of transaction also in the definition of transfer. Earlier, there was no point number 6, but income tax amended this transfer definition that if somebody has taken the possession and the other has taken the consideration, then even without registry, we will treat it as a transfer and capital gain would be charged on Mr. A. Stamp duty also need to be paid. That is under section 53 of Transfer of Property Act. We do not have any provision with that act. We have to understand what is going to be happen under income tax. So under income tax, the implication has been merged under two heads of income, under house property and capital gain. So capital gain say, we will consider it as transfer and will charge capital gain. And house property says, the person who is having the possession, we will consider him as a deemed owner. Even he does not have the title. The registry is still in the name of Mr. A. The legal owner is Mr. A, but we will assume Mr. B as the deemed owner, and any income from that house property in the nature of rent, etc., is going to be taxed in the hands of Mr. B. Understood? So this is the example that Mr. A enters into an agreement for the sale of his house. The purchaser gives the entire sale consideration to A. A hands over complete right of possession to the purchaser since he has realized the entire sale consideration. Under the Income Tax Act, the above transaction considered as transfer, even legal title did not transfer yet. Okay. 7 point also exactly same condition must have been discussed by the faculty under section 27 of deemed owner. I will ask point number 7. I have already uploaded the notes of this chapter. You can go through it. Example is also here. I will ask any one of you the concept of point number 7 in this case in the next class. So you have to go through with it. This is just like your homework. You have to do it. Point number 7. I will ask you in the next class. So that was the definition of transfer and capital asset and how to calculate the basic capital gain format we have discussed. And I told you after the definition of capital asset and transfer, we will understand what is long-term capital gain and short-term capital gain. To understand what is long-term capital gain and short-term capital gain, we have to understand what is long-term capital asset and short-term capital asset. So if there is a long-term capital asset, the gain would be long-term gain or long-term loss. If the asset is short-term capital asset, then the gain would be short-term gain or short-term loss. Okay. So this is explained in the detail, but we have the important format. With the help of that format, you can understand easily what is long-term asset and short-term asset. So here is the format. So we have having some amendments on or after 23rd of July regarding the definition of long term and short term, and multiple provision has been changed under the capital gain chapter on or after 23rd of July. So definition also split into two parts. If you want to understand the nature of capital asset, the provision says before 23rd July 2024. If in the question says that the transfer took place before 23rd July 2024, before this date transfer took place, then you have to find out the nature of asset, long term, short term, with these provisions. And it says securities other than unit listed in a recognized stock exchange, units of equity oriented fund or unit of UTI, and zero coupon bond. If these assets have been transferred when before 23rd July 24, then if it is transferred up to 12 months, that would be short-term capital asset. Suppose if I transferred any security, if I purchase that security and transfer it before 23rd of July, and I held that security up to 12 months or less than 12 months, like I am selling it, I purchased in 2023 and I transfer it after 9 months before 23rd of July or after 10 months or after 11 months. So that would be called short-term capital asset. And if that is a gain, the gain would be short-term capital gain. So up to 12 months, if at the date of transfer and the date of purchase, the duration is up to 12 months, that would be treated as short-term capital asset. But if I transfer it after 12 months, suppose I have purchased those assets in year 2022, and I have transferred it before 23rd of July, suppose on 20 July 2024. So I have held this asset for more than 12 months. So if the assets fall in this category, that would be called long-term capital asset, and the gain would be long-term capital gain. If those assets fall in this category, if these are unlisted shares or land or building or both, then the time is 24 months. Up to 24 months, if we have transferred, that would be short term. After 24 months, if we have transferred, that would be treated as long term. If that is other than these two categories, suppose this is A category, this is B category, and now this is C category. If your asset does not fall in A or B, that means we are talking about unlisted securities other than shares and other capital assets. The limit was 3 years. Like I have jewelry and I transferred my jewelry before 23rd of July. I held it for 30 months. After 30 months, I've transferred it. That would be short-term capital asset. If I've transferred it after 36 months, that would be long-term capital asset. So earlier, there were three categories, 12 months, 24 months, and 36 months. But on or after 23rd of July, suppose I transfer my asset on or after 23rd of July, then there is only two categories. If the asset is securities listed in recognized stock exchange, units of equity oriented fund or UTI, or zero coupon bonds, the 12 months duration would be short term, more than 12 months, long term. Any other asset except category A, any other would be fall in this category. Clear? You can also read the provision from here also. So we have described this up before 23rd of July in provision like this also, 12 months, 24 months, and 36 months. And on or after 23rd of July, the category is only A and this category is only B. Earlier it was three categories, now only there are two categories. Now there is a very interesting note also. As per section 50AA, capital gain arising from transfer of the following asset always be capital gain arising from transfer of short-term capital asset irrespective of the period of holding. So these three assets would always be treated as short-term capital asset, whether held for more than 12 months, 24 months, or 36, irrelevant. So there is a fixed rule as per section 50AA for the three assets. Units of specified mutual fund, if it is acquired after 1st April, on or after 1st April 23, they will always treat it as short-term capital asset. Whether they are transferred after 12 months, 24 months, or 36 months, they will always treat it as short-term capital asset. Market-linked debenture, always short-term capital asset. An unlisted bond and unlisted debenture, if they are transferred on or after 23rd of July, they will also treat it always short-term capital asset. So, with the help of this chart and the above provision what we discussed, now you can understand what are short-term capital asset and what are long-term capital asset. I hope it's clear. Mr. Dhanush is saying, sir, what is that 23rd July 2024? 23rd July 2024 is a date on which capital gain provision has been amended by the income tax department. So there are some concept has been changed on or after 23rd of July 2024. So if your asset transfer before this date, the concept or the solution would be different. If your asset has been transferred on or after 23rd July 24, the solution could be different. How it would be different in numerical and practical things that we will discuss later. Do not worry. Next is, sir, in before and after condition, A in both situation are same. No, then why it is given twice? Because we have to explain to the student that what is the new provision on or after 23rd of July 2024. So the format should be complete, Priyanshi. So that's why we have to show that still the A point was exactly the same. The B or C has been merged together, and that is now for 24 months in both cases. Okay. So Act does not show like this that it is the same provision, so leave it. So student would be confused. So they make provision in detail. So that was the conceptual short-term capital asset, long-term capital asset. Now we will discuss indexation concept, but after a short break. So we will resume after a short break. You can have your tea, coffee, etc. So Ashok sir, can we go for a short break of 10 minutes? Even I believe you must have your tea, coffee, water, etc. for your energy. So we were discussing the provision of capital gain, and we just gone through the concept of capital asset, the concept of transfer, how to basic format of capital gain, and how to calculate capital gain on the basis of that format. Then we have gone through with the definition of short-term capital asset and long-term capital asset. And as I told you, there is an amendment in the capital gain provision, multiple amendments from on or after 23rd July 2024. So if the question belongs, if the transfer does happen before 23 July 2024, so there would be separate short-term capital asset and long-term capital asset definition. And if it does on or after 23rd July 2024, the concept would be changed. Not even only in case of nature of asset, but there are different rate of taxes, the different calculation procedure also, if it has been done before or after 23rd of July. So what are the different rate of taxes in this situation? How to calculate tax, the indexation concept will also going to be changed before 23rd of July and on or after 23rd of July, that we will consider one by one. So now we will understand the concept of indexation. So in that format of calculation of capital gain, we have seen that there was sale consideration, then expenses on transfer. After subtracted it, we will receive our net sale consideration. And after that, there was a concept of index cost of acquisition. Cost of acquisition or index cost of acquisition, cost of improvement, and index cost of improvement. So what is that indexation? What is that index cost of acquisition? We have to understand this first. So let's discuss it. So what does that indexation means? Indexation is applicable only on long-term capital asset. So indexation concept is applicable only in case of long-term capital asset. First of all, you have to understand this thing. And as we already know what is long-term capital asset, so on only those long-term capital asset, if they transfer, then we will apply indexation concept. Now, what that indexation concept? So it explain you like this. Suppose if you purchase a building in 2005 for 10 lakh rupees and now sold it in 2024 for 90 lakh rupees. So there is a gain of, technically, if we calculate a gain, that would be 80 lakh. And suppose the tax rate is 20%. So you have to pay capital gain tax approximate 16 lakh rupees on this gain. Now there is a problem. And this problem only arises in this chapter, not in any other chapter. Why? Because we are considering the currency value of two different years. We are taking the currency value of sale consideration of 2024, but for the purpose of reducing it as cost of acquisition, now we are taking the currency value of 2005 10 lakh rupees. In other heads like income from house property or salary head or PGBP, generally all the amounts belongs to a single year. Under capital gain, the currency value, the sale consideration value would be for another year, and the purchase consideration could be related to another earlier year. So there would be a huge difference due to inflation, etc. So that is explained in this example. So in this example, you can see 16 lakh would be the tax if this scenario happens. So the profit will arise 80 lakh, which is liable to tax. But the problem is that assessee says that for sale consideration, you are taking the currency value of 2024. But to deduct cost, we took currency value of 2005. So the currency we spend in 2005 is rupees 10 lakh, and in 2024, we cannot purchase same building for rupees 10 lakh. So I spent 10 lakh rupees in 2005 to purchase a building. But if I want to purchase that building in 2024 again, so I won't be able to purchase that building for 10 lakh rupees. But for the purpose of calculation, you are reducing my money power of 2004 against the currency I received in 2024, that is 90 lakh rupees. So the power of money is decreasing. What we could purchase in 100 rupees in 2004, to purchase those things in 2024, we have to spend more money. So the power of purchasing of money is reducing due to inflation, etc., etc. So Asasi was saying the same thing, that I spent 10 lakh rupees in 2005 to purchase that property, and I sold that for 90 lakh rupees. So this 90 lakh rupees what I receive in 2024 does not have that purchase value which it should have in 2005. So you have to increase my purchase cost, which was as per the 2005 value 10 lakh. You have to increase it and you have to find a value which it should have been in 2024. So for that purpose, indexation concept has been introduced. So we need to spend more money. So this is not justified to calculate capital gain. We took currency value of 2024 for sale and 2005 for cost. That will arise higher tax to assessee, which is unjustified. So we need to find out the currency value of 10 lakh rupees in 2005 in the 2024. So Asati was saying, you just do one thing. I spent 10 lakh rupees in 2005. So just please calculate the value of that currency in 2024 with the help of inflation, etc. So whatever that value, that need to be subtract or deduct from the current currency value of sale consideration. With the help of indexation, that is why indexation concept comes into the place. Now what will happen with this value? So if that indexation concept does not here, the gain would be 80 lakh and the tax would be 16 lakh. Now if we apply this indexation concept, now the sale consideration is 90 lakh and the cost was 10 lakh and it is of 2005. So this purpose, indexation sheet has been prepared. Department has made this cost inflation index, supposing that if 100 rupees was the value in 2001, then in the next year that 100 rupees currency value would be 105, the next year 109, the next year is 113, and after that in the current year, our financial year 2024-25, that 100 rupees value now is 363. So if you purchase any property in 10 lakh rupees in 2005, so you have to divide with the index of that year. So the index of 2005 was 117. So with the help of this, department made a provision of indexation. It says we will divide this value with the index of that year in which you purchase that property and multiply with the current year value, because we have to compare this value with the current year currency value. So what will happen according to this? Now the value would be approximate, the 10 lakh would be approximate 31 lakh. So if we will subtract 31 lakh now, the gain would be 59 lakh and the 20% tax would be now almost 12 lakh rupees, which was earlier 18 lakh rupees. So you can see with the help of indexation, my cost would be increased. And if cost would increase, that would be called index cost of acquisition. And due to the increment in the cost, my gain would be reduced. And that's why I will have the benefit of tax. Not only this, if after 2005, suppose assessee also incurred some expenditure, some capital expenditure, suppose 5 lakh rupees capital expenditure they have done in 2010. So that would be considered as cost of improvement. And you will index that also. So for the purpose of cost of improvement, 5 lakh rupees, we have incurred expenditure in 2010. So we will take the value of 2010 index, that is 167. These value would be given in the examination, do not worry. You have to only remember two values. The first one is 100 and the current is 363. All other value would be given in the question. So the 2010 value was 167. So if there is any cost of improvement in capital nature, we will also index that. Multiply would be with the year of transfer. So that 5 lakh would be now 10.8, approximate 11 lakh. So out of this 59 lakh, we will reduce 11 lakh more. So that means my gain would be only 48 lakh and the tax would be almost 9.6 lakh. So where we need to pay almost 16 lakh rupees tax, that is reduced to 9.6 lakh with the help of indexation. So there are few things we have to understand. Indexation needs to be done only on long-term capital asset. The purchase price, that means the cost of acquisition indexation will be done, as well as the cost of improvement indexation also need to be done. The index value would be given in the question. The first index of 1, 2, that is 100 you need to remember. And the last of your current year is 24-25 financial year, 363. You have to remember. All other year, if that is in the question, the index value would be given in the question. I hope it's clear. Now, I made you understand how to apply this indexation concept. Now we have the specific formula also. If I'll ask you how to make this formula, so the formula would be purchase price multiplied by the transfer year index and divided by the purchase year index. So that is the formula what we are going to understand. But now there is a problem arise. What is the problem? The problem is this, that the index value has been started from year 1, 2, that is 100. Suppose somebody has purchased any property in 1995 for 10 lakh rupees and sold it in 2024 for suppose 90 lakh rupees. Now, if I'll try to index this value, index cost of acquisition of this value, that is 10 lakh rupees. So I'll multiply with 363. But how I will take the index of 1995 when the index was started from 2001-2? So the provision has been made like this. If any asset has been purchased, so the index value would be the purchase year value, purchase year index value, or the first year index value, 1/4/2001-2 value, whichever is later. The provision has been, the formula has been drafted like this. So what will be the impact of this formula? If the asset was purchased before 2001, so purchase year is in this example is 1995. What is the index of that year? We don't know. But 1/4/2001 index is 100. So later would be 100. So we will use 100 index if the asset has been purchased before 1/4/2001. If any asset has been purchased on or after 1/4/2001, then that purchase year index will come automatically with the help of this formula. Suppose the purchase year is 2005. Then what will happen? Here will be 2005 index. That was 117, I guess. Or 1-2, whichever is later. So later would be this. So in the summary way, I can say you that if purchase is before 1/4/2001, index would always 100. If purchase year is before 1/4/2001, index will always 100 because later year would be always 100. If it is on or after 1/4/01, then always purchase year index would be there. So you can understand that if the asset has been purchased before 1/4/2001, index would automatically would be 100. And if the asset has been purchased on or after 1/4/01, then the purchase year index would be there. I hope it's clear. But one more problem arises. This is clear. in case of index cost of improvement, this formula has been slightly changed. The formula has been made cost of improvement multiplied by transfer year index. That means 363 if asset has been transferred in 24-25. But for the purpose of dividation, the provision has been made index for the year in which improvement took place. There is no later concept has been designed. No later concept. The provision says in case of cost of improvement, we will take the index of that year in which improvement has taken place. So what will happen? If improvement has been made before 2001, we cannot consider that improvement because there is no later concept. For the purpose of cost of acquisition, we have concept like this. If it is before 1/4/2001, index would be 100. If it is on or after 1401, then purchase year index would be there. For the purpose of cost of improvement, if this is before 1401, then there would not be treatment of this cost of improvement. The cost of improvement would be 0, ignored. If it is on or after 1401, then improvement year index would be taken. We will solve an example. Let me discuss the provision with you. Then we will solve the example. Okay. So these are the example, the formulas. In case of acquisition, cost of acquisition multiplied by the index for the year in which asset is transferred. And you can see for the purpose of the following value, the index for the first year in which asset was first held by assessee or financial year 1-2 index, whichever is later. So due to this later concept, even if asset has been purchased before 1/4/2001, the index would be always 100. And if it is on or after 1, then the index would be of purchase year. But for the purpose of cost of improvement, there is later concept does not here. So that's why that problem arises. If the improvement is before 1401, then you have to ignore that improvement. There would not be any treatment of that improvement. Cost of improvement, index of the year in which asset is transferred, index for the year in which improvement took place. Understand? We have the note or clarification also for this. You can see cost of improvement before 1/4/2001 will be ignored always. But cost of improvement done by assessee or previous owner, both are liable to deducted by assessee provided expenditure incurred on or after 1/4/2001. Cost of improvement in the nature of capital expenditure will be considered only, and any cost of improvement in the nature of revenue nature will not be considered. As we discussed, the indexation concept would be applicable on long-term capital asset. But there are certain exceptions also. There are certain long-term capital asset on which this indexation concept also not applicable. We can see from point number 3, indexation not applies in case of debenture and bonds, even if they are long-term. So on debenture and bonds, even if they are long-term, you will not apply indexation provision. Clear? But if the bond is of capital index bond, specifically the name is capital index bond, then we will do index on this bond. So except this capital index bond, if there is any other bonds and debenture, you will not apply indexation. But if the question says we have purchased capital index bond, then on transfer you can apply indexation concept. So first is capital index bond and second is sovereign gold bonds. On these bond also indexation applicable. except these two bonds, capital and these gold bond. All other debenture and bonds, if they are given in question, no indexation would be applicable even if they are long term. Clear? In case of units of specified mutual fund and market linked debenture, there will be no indexation and the capital gain will always be short term capital gain. So you might remember section 50AA, we have discussed short term capital asset, long term capital asset, and there was fixed rule in respect of some asset, section 50AA, and they say this one. These assets would always be treated as short term, whether more than 24 months, etc. So the other point is regarding these assets. So even if these asset has been held for more than 24 or 36 months, but because under section 50AA, they have been considered as short-term capital gain, so no indexation also on these assets. Even if in case of depreciable asset, there will be no indexation. We will discuss those later also, right? And there's a format also in which it has been explained on those long-term asset, indexation will not be done. So below is the summary showing the indexation benefit available to different types of long-term asset which are transferred before 23rd of July. So bonds or debenture, of course, no indexation. Capital index bond, yes, etc. So you can go through with this format, very simple, on the basis of above clarification. Consequent to the amendment made the Finance Act 2024 in section 48, no indexation benefit is allowed on long-term capital gain arising on transfer of any capital asset taking place on or after 23rd July 2024. Now what happened? Before 23rd July 2024, on following asset, you can take the benefit of indexation or not. Like bonds and debenture, you cannot take the benefit. On this, you can take the benefit. On depreciable asset, you cannot take the benefit of indexation. On section equity shares on which tax has been paid STT, you cannot take the benefit. On units of equity oriented fund, you cannot take the benefit of indexation. Other long term like jewelry, shares, etc., you can take the benefit up to, or we can say before 23rd July 24. But on or after 23rd July 2024, the concept has been changed. Now provision says no indexation. Bhul jao indexation. Khatam. If the asset has been transferred, long-term asset of course, because short-term we don't have any indexation concept. So if any long-term capital asset has been transferred on or after 23rd of July 2024, any long-term capital asset, there would not be any indexation benefit. The end. So this is the last year you are actually going through with the indexation concept. If on or after 23rd July 2024, any asset has been transferred, then there would not be any indexation benefit except in one case. Only in one case there is indexation benefit even if the asset has been transferred on or after 23rd of July, and that is in case of land or building or both. So before 23rd July 2024, indexation benefit provision according to assets are over here. On or after 23rd July, indexation benefit has been abolished, omitted, except in one case. The asset should be immovable property. Land, building, or both means only one asset has been eligible for indexation benefit, that is immovable property. And the benefit can only be claimed by a resident individual and HUF. If you are a partnership firm, if you are a company, etc., then if asset has been transferred on or after 23rd of July, indexation gone. But only in case of immovable property, if that has been transferred by a resident individual or HUF, they can claim the benefit of indexation. On any other asset, indexation has been gone on or after 23rd of July 2020. Okay. So while computing tax on long-term capital gain on transfer of land or building or both, has the option to take the benefit of indexation under section 112. So if any immovable property has been transferred, if it's a case of immovable property, so if it has been transferred by a resident, individual HUA on or after 23rd of July 2004. So only in this case, there is a benefit of indexation. So if you are a resident individual HUA transferring your immovable property on or after 23rd July 24, now you have the two options to calculate tax. Option 1, take the benefit of indexation. That means you can index your cost of acquisition, you can index your cost of improvement, and then whatever capital gain, long-term capital gain you will have, you need to pay tax at the rate of 20%. You have option. And the second option, without indexation, also you can pay tax. Now you can reduce simple cost of acquisition and cost of improvement without taking the benefit of that indexation formula. Then whatever long-term capital gain you will have, you can pay tax at the rate of 12.5%. So you have to calculate with both cases. And the lower you need to choose for the purpose of your tax liability. Understood? For the purpose of your tax liability, you have to apply both. But for the purpose of GTI calculation, remember, this is a very interesting concept. For the purpose of GTI calculation, you will calculate salary and income, then you will calculate income from house property, then you will calculate PGBP, then you will calculate capital gains. For the purpose of capital gain, when you will calculate, you will always calculate your capital gain without indexation. So for the purpose of GTI calculation, then income from other source, and you will be GTI. So for the purpose of your GTI, you have to calculate your long-term cap gain always without indexation. You need not to calculate. If the question asks you, just only calculate GTI, no tax liability calculation requirement, then you have to calculate your GTI taking this long-term capital gain without indexation, whatever it is. Clear? But if the question asks that you need to calculate tax liability also, then even for the till the calculation of GTI, you will calculate your GTI without indexation concept. But for the purpose of tax calculation, you have to calculate tax separately via both methods, 20% and 12.5%. And for the purpose of tax calculation, when you will write it down capital gain tax, you will take the lower capital gain tax in this tax calculation format separately. So this indexation concept need not to be shown up to GTI level. But if there is calculation of tax requirement, then the lower you need to include as your capital gain tax in your tax liability format. Understand? This has been explained specifically over here. So you can see an individual resident or HUA, while computing tax on long-term cap gain on transfer of land or building or both, has the option is with you, to take the benefit of indexation under section 112 in respect of long-term capital gain arising on transfer of land, building or both, which is acquired before 23rd of July and transferred on or after 23rd of July. Accordingly, long-term cap gain on such transfer of land or building or both are subject to lower tax, 12.5% without indexation, 20% with indexation. Not that GTI format case has been explained over here. It may be noted that this benefit to a resident individual or HUF is to be given only while computing tax on long-term under section 112. Only under the tax calculation format you have to show that indexation concept, okay? Not while computing income under the head capital gain. So for the purpose of calculation of gross total income, you always calculate your gain without taking the benefit of indexation, which would form part of your GTI or TI. Thus, for computing the capital gain to be included in GTI, indexation benefit not to be given, even in the case of resident individual HUF transferring land or building on or after 23rd of July 2024. So it's quite complicated. But we will discuss this topic twice or thrice again in this chapter, because when I will explain you how to calculate tax, etc., this will come again. So because we are going to repeat this concept twice or thrice, so after that you will understand that yes, in this case we have to calculate tax like this. So the basic concept of, or we can say more than basic concept of, capital gain has been completed. We have gone through with the capital asset, the transfer definition, short-term, long-term, indexation concept, on which indexation can be done or indexation cannot be done. Now the very important topic. Before going to this topic, let me solve an example with all of you. Mr. Ishan Bisht is saying, sir, but if index value for before 1/4/2001 is given, then we can take that no for improvement. There is no index values before 1/4/2001. Department or act has been only started the index value 100 from 2001. So there is no index value before 2001 exist. So you cannot take that value because it does not exist. Okay. Okay. Anush is asking, sir, why it is like that? Anush, this is income tax. I told you in the story first day, I guess, that Einstein said that this is the most difficult subject of his life. Income tax is like this because it is correlated. Multiple amendments actually has been made in this act, and it is from 1961. So due to this, the whenever there is act from 1961 and we are in now 2025, so multiple amendment has been made in this act. So it is quite complex, we can say, and difficult also. That's why the new income tax has been, DTC has been implemented from next year. So you have to read these provision, whatever it is, it is. So don't ask why. You have to learn all those provision. Mr. Sangi Nathavani is saying, sir, please upload these notes. I have uploaded the notes already. You can go through on the BOS portal and you can download it, of course. Okay, Priyanshi is saying, sir, means for just GTI indexation not considered. But for the same question, if we ask to calculate tax further, we will consider indexation and calculate gain the taxable value of capital. Yes, absolutely right. Wi-Fi from Wi-Fi, Priyanshi, you got it. Okay. Miss Nidhi Vishwakarma, cost inflation index कैसे calculate किया गया है, sir? This will be explained by the finance ministry. They have taken some inflation effect and other effect also. So they just provide us the inflation index, and in the examination also nobody is going to ask you कि inflation index कैसे calculate किया है. So they are having a separate formula for derivation of that. So that is out of your syllabus. अभी जो है उतना कर लो. It is more than enough. Jitendra Pokle is saying story. A story definitely would be after the end of the class. So after 8:30, I will tell you a very interesting story, very new story also. So go ahead. Now we are discussing a simple question. Okay. So suppose there is Mr. A. He purchased a land for rupees, suppose 10 lakh in year 1995. Clear? Or we will do it. Okay. He has done some construction on this land for rupees 2 lakh in 1998. Some other construction has been done for 3 lakh rupees in 2005. Clear? This property has been sold to Mr. B in 2024 for 95 lakh rupees. Expenses on sale was 2%. Now, if we need to calculate capital gain, then what are the basic element we need? Like if we want to make a dish, we need some ingredients together, vegetables, spices, etc. So first of all, we have to arrange those ingredients with us. After that, we would be able to make that dish quickly. So if there is a numerical in front of you, in case of income tax especially, do not try to solve it by reading the numerical. If you reading this numerical and you think, okay, I will do like this, I will do like this, and it will be solved. No, don't try to do this thing. Just find out the components you need to solve this question. Let me tell you what are the basic component to solve a capital gain question. First of all, in solution of all questions of income tax, we have to write it down like this, that computation of capital gain in the hands of, whether you are solving a salary question, etc., then you have to write computation of salary income in the hands of Mr. A for assessment year 2025-26. So this format, this language, you have to write it down in solving each and every questions of under income tax. Okay. Then for the purpose of calculation of capital gain, we have to find it out firstly the period of holding. The period of holding means whether it's a long-term asset or short-term asset. The asset has been transferred in 2024. Let's take the date 1st May 2024. So I am taking the date before 23rd of July. Okay. So period of holding means the time we held that asset, and it has been held from 1995 till 2024. You need not to write it down the year and months and days. You can see it's more than 3 years and more than 2 years considered, because in case of building, the asset has been transferred before 23rd of July. So 24 months concept would be applicable, and you can see the period of holding is more than that. So we will write it down long-term capital asset. So you always need to start your capital gain question like this. Next example, when I will solve it, of course, I will not going to write it down this starting format because it will take our time. So I'm just trying to tell you that in every question, you have to solve it like this. You can go through with the study material. You can say the illustration, solution, they all have been solved like this. Then we need sale consideration. So what is the sale consideration in my question? It's 95 lakh. Simple. Now less expenses on transfer. And it is saying 2%. Automatically, if it is percentage, it's always need to be applied on sale consideration. That would be 1.9. So the remaining value would be my net sale consideration. I hope it's clear till now. Now we have to reduce. Now, because the property has sold before 23rd of July, so we can apply the indexation concept, and the rate would be 20% for tax liability. The rate would also going to be discussed later, but there is no benefit of without indexation or with. We have to apply the indexation concept. So we will take index cost of acquisition. So the cost of acquisition, we are taking 10 lakh. There's a different concept also for taking cost of acquisition or the FMV, but for this question, we are taking the cost of acquisition 10 lakh, which has been given in the question, multiplied by 363. And you can see the property has been purchased before 2001. So we have to take 100 as our index value. So according to that, my cost would be 30, index cost acquisition would be 36,30,000. Now, if you see index cost of improvement, so one improvement is before 2001. So that is going to be having no impact. We have to ignore it. And the 3 lakh is in 2005. So 2005 index value is we have to take the index value as per the financial year. So I guess 117 it was. Yes, 117 it is. So 3 divided by 117. That will result 9.30 almost. Fine. 9.31 we can do it. So the remaining would be my long-term capital gain. That would be 47.49. If we need to calculate tax on it, so rate would be 20%. That would be covered under part 2 of capital gain. So this is the basic question. Till now, what we have discussed, we have seen a question on behalf of this. You can see there is a capital asset, there is a transfer, there is a sale consideration, there is expenses on sale, there is indexation concept we apply, etc., etc. Okay. So Priyansh is saying, sir, it will be double calculation in the exam. It will be time consuming also. Yes, of course, it would be a double calculation, but do not worry. When the examiner is making question like this, so of course, they will assure this thing that if you are taking double time in this question, that they will make other question easy or there would be less number of questions. So they are very smart. They understand that you have limited time. So if they are giving you double calculation questions, so other question would be easy. Okay. So somebody wants to ask something. Somebody has raised her hand. Who wants to ask? This Nidhi. Yes, Nidhi, what you want to ask? Can we unmute Nidhi Vishwakarma? She has some query. You can send your query in chat box, Nidhi, if you want. If you want to ask, then.
हेलो गुड इवनिंग सर।
Yes, good evening.
सर इस क्वेश्चन जो एग्जांपल आपने समझाया है उसमें 1995 का है, तो इसमें फाइनेंशियल ईयर में तो कॉस्ट इन्फ्लेशन इंडेक्स तो दिया नहीं है, तो फिर 366 क्यों लिया गया है?
निधि, जो ट्रांसफर ईयर है ना, ट्रांसफर ईयर वो तो 363 है ना। वी हैव ट्रांसफर्ड दैट एसेट। हमने ये एसेट ट्रांसफर कब करी है? 2024 में।
24 में।
ट्रांसफर ईयर तो 363 आएगा। 1995 का इंडेक्स हमारे पास नहीं है क्योंकि इंडेक्स स्टार्ट हुआ है 2001 से।
1 से, यस सर।
तो परचेज कॉस्ट ऑफ एक्विजिशन के लिए रूल बनाया है कि अगर कोई एसेट 2001 से पहले की है
जी सर,
तो इंडेक्स हमेशा 100 लिया जाता है। इंप्रूवमेंट में ये रूल नहीं है। तो जो इंप्रूवमेंट 2 लाख रुपए का 1990 कब का है हमारा? 7 का है किसी का,
यस सर।
98 का, उसमें ये बेनिफिट नहीं है। उसमें इंप्रूवमेंट तभी लिया जाएगा जब वो 2001 के बाद का होगा। बट कॉस्ट के लिए ये बेनिफिट है कि अगर कॉस्ट ऑफ एक्विजिशन 2001 से पहले की है तो हमेशा 100 लेना है, और अगर वो 2001 के बाद की है तो फिर वो जिस ईयर का है उस ईयर का इंडेक्स हमें लेना पड़ेगा। ये तो हमने डिस्कस किया है कॉस्ट ऑफ इंडेक्सेशन के प्रोविजन।
ओके सर, थैंक यू सर।
Soumya is asking, sir, why did we ignore 2 lakh amount of construction cost? Soumya, we have discussed in this provision. तुम लोग सो जाते हो लगता है। We have discussed in indexation concept that cost of improvement incurred before 2001 will be ignored. Why it will be ignored? We have discussed this also. That because we do not have indexation before 2001 and for the purpose of cost of improvement, it has been in the formula that we have to take the index value of the year in which improvement took place. And because we do not have improvement index value before 2001. So all cost of improvement, if incurred before 2001, we have to ignore them. Okay. So that was the example. Till what we have discussed today, the example is actually covered almost all these provisions. Now the very important provision regarding cost of acquisition. So what should be the cost of acquisition? The cost would be changed in different scenario. In some circumstances, we have to take some cost, and other circumstances, we have to take something else as a cost. So what should be the cost? That is defined by section 49. So we are going to discuss section 49 one by one. Okay. Let me tell you one thing. In the next lecture, in the starting of lecture, we will solve some MCQ. And in the next lecture also, I would like to ask that summary of this chapter, what we are going to cover till today. So somebody will give a recap or a summary of that chapter as we did in our basic concept chapter and residential. I generally ask you, any one of you can explain in short whatever we have covered till first chapter in capital gain. So in the second class, in the starting of class, somebody will explain me the summary of capital gain chapter, and then we will solve MCQ, and then we will go further in capital gain chapter. Okay. Miss Kirti is asking, sir, in exam that inflation index given or not? I have told you all that in the examination index would be given only first year index, that is 100, and the current year 363. You have to only remember these two index. All other index would be in the question. Okay. Okay, Priyanshi asking, sir, if sale takes place after 23rd July 24 and Mr. is not individual or HUF, then we will not consider indexation. Yes, if they are not individual HUF, or if they are individual HUF but not resident, then only without indexation concept would be applicable. In case of cost acquisition and cost of improvement, both cases. Absolutely right. Now moving on to determining cost of acquisition of capital asset. So for that purpose, we have a specific provision also, and I have also prepared a chart. So I would like to discuss that chart with you, so that will be really easy to all of you to understand what cost of acquisition we need to consider in different scenarios. So this is our capital gain cost of acquisition chart 1. And this is the cost of acquisition chart in case of non-depreciable asset. So this is the chart for non-depreciable asset. For depreciable asset, we have section 50 specifically, in which we will see how cost would be determined in case of depreciable asset. So there are multiple cases we are going to discuss. The first one is goodwill of business, copyright, patent, trademark, etc. So technically we are talking about intangible asset. So point 1 is discussing about intangible asset. So if there is any intangible asset in the question, then how to determine the cost of acquisition of that specific intangible asset, whether it's goodwill of business, copyright, patent, trademark, etc. And you can see whether these assets have been purchased on or before. This is the signature of on or before. Whether it's on or before or after does not matter. Because in some asset, if those have been purchased before 1/4/2001, cost provisions are different. And if it is purchased on or after 1/4/01, the cost of acquisition provisions are different. But in case of A category, that means in case of intangible asset, the provisions are same, whether it has been purchased before 1/4/2001 or on or after 1/4/2001. So if that is an intangible asset, does not matter whether it purchased before of 2001 or on or after 2001, the provision will applicable like this. And it says, if these intangible assets are self-generated, at goodwill of business, you did not purchase any business, you started your business and you create your own goodwill. Suppose there is a restaurant. It has started a new restaurant. And after 10 years of working, it has created some goodwill. And when he transfers this business to someone else, he will charge some amount for goodwill also. You must have gone through with the provision in accountancy. When there's a business transfer cases, so we have to see there's a goodwill or capital reserve. So if your business has a good reputation, so you will charge extra. Suppose your business value, your business net value is 50 lakh rupees. Your asset minus liability, etc. Your net worth is 50 lakh. But you are charging 55 lakh rupees. So what is for that extra 5 lakh? That is for goodwill. So if I have started a restaurant and I'm now going to transfer it to someone else, my business value is 50 lakh, but I am charging 55 lakh. So I'm charging 5 lakh for that goodwill. So that 5 lakh would be the sale consideration for my goodwill. Remember very carefully, we are not discussing now the sale consideration. We are discussing the cost of acquisition. So the provision says, if your goodwill is self-generated, so I started my restaurant, I started my hotel, I started my shop, etc. I did not purchase this hotel, restaurant, or shop from anyone else. So whatever I am charging for goodwill, 5 lakh rupees extra, that would be my sale consideration. And my goodwill is which kind of goodwill? Self-generated. I made this reputation. So if your goodwill of business or your copyright or your patent, trademark, you did not purchase from anyone, that is self-generated, then the cost would be always nil. Having cost nil is not good for the purpose of tax. That means 5 lakh would be my sale consideration and my cost would be nil. So full value would be my capital gain. So sale consideration, you can see 5 lakh and cost is nil because my goodwill is self-generated. So full 5 lakh is going to be taxable. So if your goodwill of business, trademark, copyright, patent, etc., if that is self-generated, it would be mentioned in the question that it is self-generated or it is purchased from somewhere. So if it is self-generated, the cost would be always nil. If it is purchased from somewhere, suppose I have transferred that restaurant to someone for 55 lakh. So he has paid me 5 lakh rupees for goodwill. So for my cost acquisition, goodwill would be, cost would be 0. But he paid me 5 lakh rupees for goodwill. Suppose after 2 or 3 or 4 years, he transferred that restaurant to someone else. And he charged for goodwill 8 lakh rupees. So now when the sale consideration is 8 lakh rupees for his goodwill, now his goodwill is not self-generated because he purchased that goodwill from me. So if he paid 5 lakh rupees me, so that means the cost for him would be 5 lakh. So if he received for goodwill 8 lakh, then for his cost of acquisition, the purchase price of that would be goodwill 5 lakh. What he has paid me at the time of purchase. So if your goodwill has been purchased, then the cost would be purchase price. If it is self-generated, the cost would be nil. Very simple concept. You can just remember one thing. If for intangible asset, if you paid something from your pocket, that would be your cost. So if that is self-generated, you did not pay anything, so cost would be nil. If you purchased goodwill from anyone else, then at the time of sale, the purchase price you have paid would be your cost of acquisition. As simple as that. Very simple. There is nothing complicated. If you paid, that would be cost. If you did not pay anything, that would be self-generated, zero cost. Same concept applicable in case of goodwill of profession. Even whether it's before 1/4/2001, on or after 1/4/2001, same concept, no difference. From share, etc. The third case, shares, etc. You can see the concept would be changed. Before 2001, the concept would be different. On or after 2001, the concept would be different. So in case of goodwill of business, copyright, trademark, patent, and in case of goodwill of profession. Now, goodwill of profession is having some different concepts, slightly different. It says goodwill of profession would be of two types, personal nature or commercial nature. Goodwill of profession like CA firm. Fine. So CA firm is a like commercial nature business. If there's a partnership from multiple CA, then it's a commercial goodwill. But suppose the personal goodwill of profession, suppose there is a doctor who is running a clinic. So that degree belongs to him. Can anyone else run that clinic if doctor give his degree to that person? Is it possible to transfer your knowledge to someone? Suppose I am a chartered accountant. Why suppose? I am a chartered accountant. And suppose something else that I am transferring my degree to some of my article. I say, okay, this degree now I am transferring to you. From tomorrow, you would be a chartered accountant with the name of Ankit Sharma. Is it possible? No. The personal goodwill of profession cannot be transferred. Now, very interesting sentence this is, that goodwill of profession, personal nature cannot be transferred. And if this cannot be transferred, then there could not be capital gain. Because for the purpose of capital gain, there would be transfer. So goodwill of profession of personal nature cannot be transferred. And if it is cannot be transferred, so automatically there is no capital gain can arise. You cannot transfer your goodwill. So the concept of capital gain would not be applicable. But if there is a partnership firm of architects, engineer, etc., and if some new partner adding into this partnership firm, so we can charge payment for goodwill from him. So in that case, again, the same concept like goodwill of business, if it is self-generated and we are charging something for goodwill, that would be sale consideration and cost would be nil. But if we purchase that goodwill from some person, and then if we are receiving something for goodwill of profession, then my cost would be purchase price. Same concept as goodwill of business. I hope it's clear. Please, can you zoom that section? It's not visible. Okay. Kevin, I will zoom it. Okay. I have uploaded the notes also. I will zoom it again. But the fact is, if we pay tax, we will be, let me zoom it first. Clear now? Okay. So there was some query. Okay. But the fact that if we pay tax will be less, but if we don't pay cost, it's nil. Tax will be more, money will go anyhow. Yes, you can say that, of course. Kevin is saying, thank you, sir. You're welcome, Kevin. Okay. So now you can see the provision for cost of acquisition in case of goodwill of business, intangible asset. Again, goodwill of profession is also intangible asset. We have just bifurcated these two separately because goodwill of profession is having this special character. This one. Otherwise, the provision is same for goodwill of business, copyright, patent, and goodwill of profession also. Now moving on to third case. Shares. So we are having three kinds of shares. One is ordinary shares, bonus shares, and right shares. Ordinary shares means the shares which is issued by the company. So either we are going to purchase these ordinary share from the company directly, IPO or FPO, initial public offer or further public offer, or we can also purchase these shares from the stock exchange. So there are two options. We can buy these ordinary shares from company or stock exchange. So purchase price would be my cost of acquisition in both cases, but there is some difference. Now you will see, if we have purchased the ordinary shares, whether it's from company or stock exchange, but we have purchased them before 1401. So now the provision will change. If you purchase asset before 1401, now the provision will change. This is not in case of these A and B case. In A or B case, goodwill case for intangible asset, whether purchase before or after does not matter. Either cost would be nil or purchase price. But in case of ordinary share, if you purchase them before 1401, then fair market value on 1401, that will be given in question. The fair market value on 1401 or purchase price, whichever is higher, would be taken as your cost of acquisition. So if ordinary shares has been purchased before 1401, then the FMV on 1401, fair market value, which will be given in question, or purchase price, whichever is higher, would be your cost of acquisition. If it is purchased on or after 1401, so if it is purchased before, you have to compare the FMV with the purchase price, and higher would be your cost. If it is on or after 1401, then there is no problem. Purchase price would be your simple cost of acquisition. No need to compare with FMV, etc. So again, it's very simple. If it's an ordinary share, whether you purchase it from company or stock exchange, if it is purchased before 1401, you have to compare the purchase price with FMV of 1401. Higher would be your cost. If it is on or after 1401, then your purchase price would be automatically cost of acquisition. I hope it's clear. Now, bonus shares. So what is the meaning of bonus share generally? What is the meaning of bonus shares? Okay, we are having a bonus share, and then we will have our right share concept. So what is the difference between bonus share and right share? ये मुझे बता दो कोई short में, बिल्कुल short. What is the difference between bonus share and right share? Maybe he's asking commercial में कौन सा प्रोफेशन आएगा? इंजीनियर्स कंसल्टेंसी फर्म आ सकती है, पार्टनरशिप फर्म, आर्किटेक्ट, सीए फर्म एटसेट्रा, कोई भी ऐसी फर्म हो सकती है निधि जिसमें हम पार्टनरशिप फर्म में किसी पार्टनर को ऐड करने के लिए उससे गुडविल चार्ज कर सकते हैं. Dhanush is saying, sir, it's a bit confusing. Can we continue next session? We will continue after this bonus provision. We will end this session once we discuss this bonus and right share difference. Do not worry. Okay, Rajveer is saying pre-shares bonus, low price right. Very well done, Rajveer. Exactly. Right shares are generally issued to the existing shareholder. Priyanshi is saying bonus shares also going to issue for existing shareholders. So there is not difference, Priyanshi. Bonus shares technically issued free of cost to the existing shareholder, and right shares issued to existing shareholder at low cost. Correct, Mohammad Farhan. Correct, Mr. Kevin. Very well done. Tej Prakash also correct. Harshada. Bonus are extra share. Right issued to existing shareholder at less price. Again, this is also correct. Ishan is also correct. Jendra also correct. Rajvi is also correct. Bonus shares are free shares given by company to existing. Correct. Everybody is almost correct. So in case of bonus shares and right share, how we are going to find out the cost of acquisition, and in case of other asset, how we will find the cost of acquisition, we will discuss that concept in next class, of course. So you have to do one thing, you have to revise those provision before the next session. And as I told you that in the next session, please someone summarize me the provision till now what we have discussed in very short, and we will take a MCQ also. Now the time is for a short story, a very interesting story for all of you. Stories just like that, and story would be in Hindi always as it happens as usual. So एक राजा था और बहुत ही मशहूर, बहुत ही एक अच्छा राजा, और सारी प्रजा उससे काफी खुश रहती थी. और एक उसका पड़ोसी राजा, वो उससे बहुत जेलस होता था. वो चाहता था कि उसकी इंसल्ट हो राजा की उसके सारे दरबार के लोगों के सामने में. तो एक दिन उसने अपने एक ज्वेलर को बुलाया जो पड़ोसी देश का राजा था. उसने कहा कि तुम उस राजा के यहाँ जाओ और कुछ ऐसा करो जिससे उसकी इंसल्ट हो उसके सारे मिनिस्टर्स के सामने, सारे प्रजा के सामने. तो वो जो ज्वेलर था उसने कहा हाँ मेरे पास एक तरीका है जिससे मैं ये कर सकता हूँ. तो वो गया उस राजा के पास जो अच्छा राजा था, और उसके दरबार में आके बोला कि राजा जी, मेरे पास ये दो डायमंड है, इसमें एक असली है और एक ग्लास का है, नकली ग्लास का। तो अगर आपके राजा दरबार में से कोई भी ये आइडेंटिफाई कर दे कि कौन सा असली है और कौन सा ग्लास का है, और ये बहुत ही प्रियशियस है, जो असली वाला है वो बहुत बहुत कीमती है, तो ये मैं आपको गिफ्ट कर दूँ। और अगर आप और आपके इस दरबार में कोई भी आइडेंटिफाई नहीं कर पाए, इन दैट सिचुएशन आपको मुझे इस डायमंड के जो भी वैल्यू है, जो बहुत ज्यादा थी, वो आपको मुझे देनी पड़ेगी। और आपको ये मानना पड़ेगा कि आप उतने बुद्धिमान नहीं है जितना आपका पड़ोसी राजा बुद्धिमान। तो राजा को समझ आया कि ये किसकी कॉन्स्पिरेसी है, उस पड़ोसी राजा की। उन्होंने कहा अब मना करेंगे तो फिर काफी इंसल्ट होगी। तो फिर राजा ने कहा ठीक है, हम इसे पता करते हैं। राजा बहुत होशियार था, उसने दोनों वो डायमंड लिए, एक ग्लास का था और एक रियल, बट वो देखने में बिल्कुल सेम थे। तो राजा ने बहुत कोशिश करी, बट वो आइडेंटिफाई नहीं कर पाया। उसके दरबार के सारे लोगों को राजा ने, अपने मंत्री को दिया, मिनिस्टर को दिया, अपने ज्वेलर्स को दिया, सबने कोशिश करी, बट वो एकदम परफेक्ट थे, कोई भी डिफरेंस दोनों में नहीं था। अब राजा को टेंशन होने लगी कि इस तरह से तो हमारी बहुत मजाक उड़ेगा। और वो ज्वेलर काफी खुश हो रहा था कि मैंने इस राजा को हराया। जब सबने हार मान ली तो राजा के दरबार में एक, बाहर, दरबार के बाहर एक साधु बाबा बैठते थे, जो ब्लाइंड थे, उनको दिखता नहीं था। तो उन्होंने राजा से, सब सुन रहे थे वो, तो उन्होंने कहा क्या मैं ट्राई कर सकता हूँ, मैं आइडेंटिफाई कर सकता हूँ क्या कि दोनों में से कौन सा असली है। तो सब लोग हंसने लगे, ज्वेलर भी हंसने लगा, राजा भी सोचने लगा कि जब हम आईज वाले नहीं आइडेंटिफाई कर पा रहे तो हाउ ही विल आइडेंटिफाई, ही इज कंप्लीटली ब्लाइंड। सो राजा ने कहा ठीक है, जब कह रहे हैं तो देते हैं इनको। तो उन्होंने, बाबा ने वो दोनों अपने हाथ में लिए और दरबार से बाहर जाके खड़े हुए 2 मिनट। और उसके बाद आके उन्होंने बताया कि राइट हैंड वाला असली है और ये जो लेफ्ट हैंड में है मेरे, ये वाला नकली है। और वो आंसर करेक्ट था। ज्वेलर ने माना कि हाँ ये बिल्कुल सही आंसर। तो वो राजा को हीरा देकर जाना पड़ा उसे, रियल वाला। और राजा को बड़ा प्राउड फील हुआ। अब सब लोग बहुत सरप्राइज थे कि जब हम सब आइज वाले आइडेंटिफाई नहीं कर पाए, तो ये बाबा जो 100% ब्लाइंड है, हाउ ही डिड दैट। तो उसके जाने के बाद ज्वेलर के राजा ने उनसे पूछा कि आपने कैसे पहचाना। तो उन्होंने कहा मैं इन दोनों को लेकर आपके दरबार के बाहर गया, वहां धूप आ रही थी, और वहां 2 मिनट मैंने अपने हाथों में उन दोनों को पकड़ा। तो व्हाट हैपेंड, जो ग्लास वाला है वो गर्म हो गया। डायमंड गर्म नहीं होता, उसकी स्पेशलिटी है। और जो ग्लास वाला नहीं था वो ठंडा रहा, जो रियल डायमंड था वो उतना हीटेड नहीं होता। सो आइडेंटिफाइड कि ये ग्लास वाला है बिकॉज वो गर्म है। सो एग्जैक्टली द सेम हैपन विद अस व्हेन यू आर स्टडिंग फॉर सीए एग्जामिनेशन। सो स्टूडेंट्स बहुत सारे एग्जाम देने जाते हैं। दैट एग्जामिनेशन इज जस्ट लाइक दैट सनशाइन। आपको प्रेशर झेलना है। पढ़ाई सब लोग बराबर करते हैं ऑलमोस्ट, बट वो 3 आवर्स की जो टेंशन है, वो जो प्रेशर है एग्जामिनेशन से 10 दिन पहले का, 15 दिन पहले का, लास्ट 1 मंथ का, वो जो बच्चा डायमंड की तरह कूल रहता है, अपनी प्रिपरेशन अच्छी करा होता है, जो नर्वस नहीं होता, ही इज द रियल डायमंड। वो उसको क्लियर करेगा। जो उस टेंशन में ग्लास की तरह प्रेशर लेगा, पैनिक होगा, वो ग्लास ही रह जाएगा, और वो उस एग्जाम को क्लियर नहीं कर पाए। सो टफ टाइम में भी, टफ टाइम में ही आपको अपनी कैपेबिलिटी प्रूव करनी होती है। आपको परफॉर्मेंस देनी होती है व्हेन देयर इज प्रॉब्लम्स, व्हेन देयर इज प्रेशर। सो आप एग्जाम के लिए तैयारी कर रहे हैं, अभी बहुत अच्छी बात है, बट लेट मी टेल यू, जब वो प्रेशर आता है बिफोर 1 मंथ ऑफ एग्जामिनेशन, और एग्जामिनेशन हॉल में इट हैपन सम टाइम कि हमारा फर्स्ट क्वेश्चन, सेकंड क्वेश्चन अच्छा नहीं होता, उस टाइम नर्वस नहीं होना। उस टाइम उस प्रेशर को एब्जॉर्ब करो, बिलीव इन योर सेल्फ, अच्छी तरह प्रिपरेशन और प्लानिंग करो। अगर प्लानिंग और प्रिपरेशन अच्छी है तो आप पास ही होंगे। देर इज नो अदर ऑप्शन। सो इफ यू प्लान वेल, इफ यू प्रिपेयर्ड वेल, लेट मी टेल यू, यू विल क्लियर दैट। सो बी दैट डायमंड एंड नॉट ग्लास। सारे स्टूडेंट देखने में कैसे लगते हैं ना, बट सारे पास क्यों नहीं होते। सबने कोचिंग भी सकता है, एक ही जगह से ली हो, बुक्स भी सबके पास सेम है, पेपर भी सबके पास सेम आता है, बट सबके मार्क्स भी सेम नहीं आते और सब पास भी नहीं, जस्ट बिकॉज how you react in tough situation, that makes you a different person. So that was a story for all of you. So we will see each other on Tuesday in our next session. तब तक प्लीज पढ़ते रहो और अपना बहुत 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 ख्याल रखिए आप लोग। Is there any query? Naina is saying, sir, please give me some guidance about how to study taxation subject as it my first class. First of all, Naina, you have to go through with the first lecture. Please, this is the request to each and everyone. In under income tax, it is a problem, or you can say it is a nature of this subject. Everything is interconnected. Like you can see, we are discussing today the agricultural land in rural area. And somebody was asking me, sir, please solve that question of capital gain in rural area. But that question we have already solved, and this provision we have already discussed in chapter number 2, agricultural income. So if you did not go through with that chapter, then this kind of problem will arise that you will not understand what is we are discussing. So Naina, it's a request from my side. Kindly go through with the first lecture, the basic concept. It is not like accounting or other chapter that they are not interconnected. We are completely interconnected to each other in case of capital gain. So go through with the chapters one by one, and you can take these classes also, but please go through those classes also. And you have to understand that once you will taking the starting classes, then you can easily correlate it with any other provision which will be connected to the previous provision. Okay. Okay. Wow, sir, what a story and super moral. Really enjoyed today's session. Okay, so have a good day. Take care of yourself. We will see each other on Tuesday. So, Ashok sir, can we close the session? Over. Thank you so much, sir. Thank you.